like to introduce myself. My name is Ted Horton. I'm a partner in Seward & Capital's Capital Markets Group. We are here today to talk about the panel on alternative financing. Like everyone else, first of all, it's very nice to be here. Nicholas, it's nice to be seeing you in person and not on a Zoom screen. We'll try to keep this short, and or at least keep to our scheduled time, and may or may not commit to questions after the last panel, but we will try to leave a few minutes at the end. So the term alternative financing, as I'm assuming most people in this room know, arose to describe the sources of capital that filled the void left primarily by the exit of traditional lending banks for ship financing following the financial crisis in 2008, and whose shipping portfolios at that time constituted about 90% of the global ship financing portfolios. Although traditional financing has come back, as we have heard in other panels, it currently accounts, by my estimates, about approximately 60% of the global financing market at the end of 2021. And during that period, the alternative financing, which is primarily on the panel today, is going to be represented by the direct lenders, but also by the leasing houses and sale-leaseback transactions, and to some extent the private equity, although that was closer to the financial crisis than it is today, have filled that void. They have become larger both in terms of market share and in terms of numbers of providers, and become more institutionalized. I'm going to ask everyone on our panel as my first question to just go briefly and to describe what their offerings are and what their products are. But our panel today represents many of the leading names in the alternative or non-bank financing in the shipping industry. To my left, the ordering is going to be Tim So, who's Managing Director of Ascension Finance. I'm going to do in the ordering of where they are involved with. Robert Jan Sujet, who is a Managing Director of Direct Ship Finance, which are two of the leading direct lenders in the shipping space. Omar Donnerstein is further down to my left with Entrust Global, which is also a major player in the direct finance, the direct lending space, and also has some structured equity investments. And who am I leaving out? Harris Antonou at the very end is going to be founder and managing director of Neptune Maritime Leasing. And finally, Alex Siebman, who is with Berrinavis, who is an advisor to the ship finance industry. So as I said, I'll start with each of you and maybe just ask you to give very briefly a description of what the products are that you're offering. Tim, I'll start with you.
Sure, thanks Ted. Good afternoon everyone. So Ascension is a first lien senior secured debt provider. We have offices in New York, London and Athens. We focus primarily on liquid assets. So within our portfolio currently we have loans secured on container ships, dry bulk, crude tankers and product tankers. And we're able to be quite flexible in terms of our terms. So we have borrowers who have asked for non-recourse facilities, borrowers who have asked for loans that will be backed by mainly spot employment vessels. And lastly, we're able to finance vessels that have maybe come to the end of their financeable age with the more traditional bank lenders as well. Thank you.
Yeah, Berrinavis basically focuses on helping clients to find the best financing solution for the challenge that they're up to. So that can be a traditional bank loan, it can be lease financing, it can be alternative lending, but it's also on the equity side. We work intensively with private equity, with family offices. We do not base listed equities or listed debt, so we focus on the private side of things.
Direct Ship Finance is a lending platform directly funded by institutional investors in Europe and in the US. We have $400 million of committed capital, and if we do what we promise our investors, that we can grow with the same group of investors to $800 million. Like Ascension, we are focusing on more liquid assets. Our target group are those owners who are sort of left alone by the traditional banks when they retreated in the last number of years. So we are focusing on small to medium-sized, family-owned, privately owned owners who are looking for senior secured financing. Sometimes I describe ourselves as a non-bank bank. So that means that if you look at the direct ship finance term sheet, those who are used to traditional shipping banks, they will recognize a lot of stuff. At the same time, we're going to talk about it a little bit later. We bring a lot more flexibility and I hope creativity to the table. But it is a alternative for the banks.
Hi everyone. For those of you who don't know us, Entrust Global launched the Blue Ocean Fund around 6-7 years ago. Since then, we've raised close to $3 billion in commitment. We funded close to $2 billion. Majority of our book, around 75-80%, is actually in Greece, so we thank you for that. I think earlier on we had the view that if we want to grow and be big in this business, we should not think ourselves as a shipping lender, but should be a shipping investor. And that means that we have initially positioned ourselves to as a one-stop shop and to do more than just senior lending. And we have done anything from senior lending, senior secured lending, all the way up to common equity, and really everything in between: mezzanine, sell-leaseback, unsecured, etc. We've been active mostly on the primary market, but earlier on, we were a buyer of many loans from financial institutions that were looking to offload those loans into the hands of funds. And we've been bidding on most of the large portfolios that were out there. And even though the majority of what we do is in the private market, we've also been active in the public market and traded bonds and looked at other securities. I think the way to think about us, and again we'll talk about the differences between the different platform, is that even though we are part of a large hedge fund, 20 billion in size, and we enjoy everything that fund has to offer in terms of infrastructure, fundraising, etc., we are still a self-managed team, a self-managed business within Entrust, and that allows us to make investment decisions very quickly. We're not subject to a cumbersome process. I sit on our investment committee together with my partner Sven Eng, and between us we make 99% of the investment decision that the fund takes.
Good afternoon, everyone. My name is Harris Antoniou. I am the founder and the managing director of Neptune Maritime Leasing, and as the name already reveals, we actually set up very recently, about a year ago, a European maritime leasing company to focus on funding mostly small and medium shipping enterprises that were left outside the radar screen of larger banks that were active in the sector. And in fact, I'm very pleased that today here we have in the panel quite a few of what we call alternative lenders, but the reality is that what we call alternative is not so alternative anymore because it's becoming mainstream. We decided to keep it simple. We're not a fund, we are a company. It was established by a cooperation of sponsors with vast experience in the shipping business, but also executives that also have worked together many years in the past. And that's what actually makes it quite exciting, because the thing that brings us together is the passion about the shipping markets. We've been in this business for more than 30 years. We believe that there is no global economy without global shipping, and we firmly believe that it was in need of dire support, and we were here to provide it. As a result, we're active in most sectors: dry bulk, wet, containers, and gas carriers. We have a preference for younger ships that are environmentally friendly, because ESG is also at the core of our mindset and offering. But that means, it doesn't mean that we don't actually look at vessels that are closer to the end of the economic life, as somebody said earlier, simply, of course, when the conditions allow us to do that. And one of the ways that these conditions are met is through our active involvement in the financing of the transition. And when I say transition, I mean not only financing new buildings that are, of course, environmentally friendly and advanced, but also looking and financing retrofits, which is, in our mind, one of the important items that owners have to consider as we're moving through to a decarbonized future. And I'm sure we're going to be talking more about that later, so I will keep it at that and give it back to you.
Great. Thanks, Harris. Alex, maybe I'll start with you on this question because you're sort of above this and have an independent view. I mean, Harris, as you're saying, the term alternative financing was maybe more appropriate at the beginning as when we turned that as it's become larger in terms of market share and more sort of institutionalized. You know, is traditional bank lending still the default sort of go-to, at least for the debt financing side, or in your advisory capacity, you know, are you seeing is that what we're calling the alternative financing is sort of more of an equal opportunity? And I guess under what circumstances do you see people going towards one or the other?
I think it very much depends on the environment in which you take the investment decision. Of course, if you've got enough time and if you have a sound business structure and you can attract bank financing for your venture, then it's most likely the cheapest source of capital and you should go exactly for that. Now, however, under certain circumstances, you need a lender that can move within a few days or weeks, onboard a client within basically 2 weeks, which I think hardly any bank can do anymore. And then you basically need a partner, a financing partner that moves. It comes at a certain additional cost, but if the investment opportunity deserves it, I mean, it can still quite well calculate nicely. And insofar, I think it very much depends on what task you have in front of you, how fast you need to move, and what corporate structure you basically, or what structure, investment structure needs to be financed, because as we know, bank financing has certain regulatory restrictions, and so far I must say that I'm pleased to say that today there's really a variety of choices, and you just need to make it fit tailor-made as to keep the cost of capital as low as possible, but also, you know, to under the given timing restrictions to come to a financing solution.
And you raise, I mean, a couple of distinctions that you raise, but one is in the cost. I mean, I know alternative financing was always viewed as sort of a higher cost capital. Is that coming down though, as there's more players in the market and more competition? Are the two costs of financing getting closer to bank financing?
Well, I leave my colleagues here from later on to comment on that.
They may have their own view.
But I can definitely confirm there's been yield compression when we first saw the first players coming to the markets. On average, I would say pricing was higher, so there's more competition, so naturally that brought down pricing. But it also very much depends on, you know, how much leverage you want to have. It can still be quite pricey if you want a lot of leverage. So I'd be a little bit careful to generalize on that. But there's more competition, there's more alternatives. In the meantime, we've also learned, you know, which alternative lenders actually perform, or which just give you a term sheet and then do not perform. So there's a lot of experience that has developed over the years, and we're glad to share that experience with you.
Maybe some of the actual providers have a view on that as well. I mean, cost or other sort of comparisons where your terms would differ terms traditional, let's say on the lending side first. Tim, I'll just start with you, but I suspect everyone will want to have a word.
Sure, I think, yes, there's definitely been margin compression just because there's more people in the market and it's no longer seen as a very niche, exotic product, and so borrowers aren't willing to pay the prices they used to do. I think having worked for a large bank before here, I don't really view the two as competing. I view them as either providing the same borrower with financing for two different assets. So a large investment bank probably wouldn't finance a vessel that gets to 13, 14 years old, whereas alternative lenders might do. In the same way that alternative lenders probably won't be very competitive on a new build. So it's possible to split your fleet in two based on its profile and then use both sources of funding, acknowledging that alternative lenders will be more expensive. Or alternatively, there are some borrowers who up to about 2 or 3 years ago could happily go to a relationship bank who also had markets business, cash management business, and essentially provided a subsidized loan to allow that borrower to receive the subsidized margin, who has completely exited that relationship. And so by definition, you will have to pay an alternative lender a bit more because there isn't that relationship revenue to subsidize the loan that you've now received from them.
Yeah, I agree with everything that was said here. I'll just add one more point that I feel that the reason that we've seen margin compression is not necessarily because because of the the newcomers and but mostly because of banks. I mean, I can share that in 2018, even 19, we were refinancing out many of the Greek banks on loans that that they wanted to get out of, and then in the last 18 months they've been doing the exact opposite. They've been refinancing us. So I think what we did, this is a very large market, and we don't usually come across each other, I think, in opportunities. So I don't think we feel a lot of competition that drives us to lower our pricing, but it's for what we see, the competition is coming from banks.
Robert, did you want to?
I want to say that it's refreshing, actually. Sorry, did I jump the queue? Sorry.
Go ahead.
Well, I remember in '93, I went to my first shipping conference, and everybody was asking how we're going to fund the gap in the market. There was a gap in the market apparently back then in shipping finance. And every time I go to conferences, there is still this discussion about gap existing. And the reality is that the liquidity conditions change over time. And there have been, in those 20, 30 years that I'm referring to, there have been a few periods where you had an acute shortage of funding. We've experienced one of these periods, and it started after the financial crisis up until recently. But now I feel that because of the presence of a number of different solutions here in this panel, but also elsewhere, owners have a choice again. And I think that's very healthy. And it's like going to a supermarket and having many, different products to choose from. I think it's healthy for the industry, and more products means that we cater for more different, for different needs of the ship owners. So that's it. It's very healthy.
So if it's not, so we're hearing there's some difference in pricing. So for the different shippers, so what are the differences then maybe in, Harris, you're on the lease side, but on the lending side? Is it investment criteria? Is there more flexibility there? Different LTVs? How does it differentiate itself from call it a bank lending model? Robert, maybe I'll start with you.
I'll take this one. Okay. I think the major difference is, of course, the flexibility we can bring to the table. I think I always call it a little bit the glass half full and the glass half empty. In the good old days, when senior secured financing was very much dominated by the banks, you basically had a one-dimensional product. Whether you had a term sheet from one bank or another, in essence, there was no real difference. Now, I think if you look at the 4 or 5 initiatives here behind the table, although we are all labeled alternative lenders, we all have a different product, and that, I think, has value. Coming back to the pricing element, I think every risk has a certain price. If I look at direct ship finance and I compare ourselves to the traditional bank product, I think we bring flexibility to the table. That can be because of a higher leverage. We are not so much focused on a hard cap loan to value. We are looking at cash flow. And if that cash flow or that cash flow projection and where we feel comfortable, whether it's our outlook on the spot market or whether it's backed by term employment, that's what we look at. And if then at the end of the day, the loan to value at day one, which is basically a day rate, bear in mind, it's a day rate. If that at that time is 52% or 57% or 62% or 67%, I do not really care. Our focus is on cash flow. Elements that we can bring to the table in a poor market is discuss backloaded repayment schedules to help an owner in a tight cash flow in the next 12 to 18 months. We can talk about pre-agreed skip options if an owner has a docking scheduled somewhere down the road and he needs to have a ballast water treatment system installed. We can talk about skipping that particular installment in that particular 1 or 2 quarters. And that, I think, is at the end of the day what has value. And of course, pricing is always important. I've been in shipping for 30 years. I've been sitting on both sides of the table, on the owner side and on the banking side. And when I was sitting on the owner side, my first comment was always that it was too expensive. But at the same time, if you have flexibility, if you have somebody to talk to who understands the business, if you can anticipate on the things that are ahead of you, that has value. That has value. More than 25 base points, more or less.
Okay. Switching gears a little bit, so I think one of the differences between on the traditional lending side and the alternative lending side of the non-bank is sort of the capital, right? The banks are lending their own money. You all have investors and sources of capital that you have to go out and get those fundings in order to lend. As the market grows, as maybe there is or isn't pricing competition, are those investors that you're reaching out to, are they easier to bring in? Are they harder to bring in? And I guess is it more governed by the demand for the lending side, or is it the supply side of the capital that you find constrains you sometimes?
So it's a really interesting question. We do have a lot of prospective people reach out to us, mainly because shipping is in the news a bit more now, and as a result, there's people interested in lending into the space. When we have those initial conversations, capital providers are pleasantly surprised by how shipping loans are structured. So you have a mortgage over a steel asset. You can add credit enhancements, such as a need for employment. And there's a lot of historical data on rates and on prices that can help you make your investment decision. And I think that's also coupled, at the moment at least, with, I think it was the FT that said at the end of the first quarter in private debt, so not just in shipping, but in the entire industry, there's about $450 billion of dry powder that needs to be invested. And given we're in a high inflationary environment, that need is even more urgent. That's probably about 4 times higher than it normally is. And so what's happened is that in the non-shipping space, that's led to margin compression, lighter terms, and people potentially doing deals that they wouldn't want to do. And I strongly believe that a shipping deal that an investor hasn't considered yet because they've never looked at shipping as a viable investment area is probably structured better and pays better than some of these loans they're being forced to do to use up their dry powder at the moment. So we're having lots of really interesting conversations. I think to your point about challenges, there's 2 main ones. The first one is, as you can see, everyone on this table has a slightly different product. And so an investor coming to me may not like my investment strategy, but would have liked someone else's on the table. So the challenge isn't finding someone who wants to have the conversation, it's finding someone who wants to have the conversation about the strategy that you're seeking to employ. And the second side is that, this room excluded, shipping is still a fairly niche industry for investors. The private credit market alone is $1.5 trillion. The amount that's spent on private lending and shipping is an absolute drop in the ocean relative to that. Most investors only hear about shipping when something goes wrong in the supply chain, like the Ever Given. So in addition to finding the right investor, you then have to dedicate quite a lot of time and resources towards getting them comfortable if you're trying to bring a different type of investor into the space. So there's definitely interest, but it is a slow burn process.
Omar, you were going to...
One small remark to add what Tim was just saying. It also depends very, very much where you talk. I mean, in continental Europe, I mean, we did our fundraising, which always has its challenges. But in continental Europe, you have a very different discussion than you have in New York. So what it means is that you need to invest in talking to as many people as possible. And like Tim was saying, then you have to find that particular investor who understands what you try to do. And then there's liquidity available, lots of liquidity available. It's not an easy job fundraising, to be honest.
Omar, I think you were going to say something. You've had shipping and non-shipping investors.
Yeah, I would just say that, when we started the fund, we probably took more than 1,000 meetings before we had our first dollar committed to us. So it does take a lot of time, especially earlier on, to educate your investors, their consultants, the board of trustees, and explain them what a ship is. They've never seen one, they will never see one. And again, that took a lot of hard work, and we're lucky and fortunate that our track record has helped now, and we see more and more interest in shipping. But look, ultimately, I think it's also a function of where rates will go. Just this week we've touched 10-year Treasury touched 3%, and of course this is a debt product. and it will be interesting to see how much, whether if we're going to see rates continue to go up, whether this will still be interesting and at what rate.
I just wanted to add a couple of things as well from my side. When we started the effort last year, we had the same dilemmas and questions in our minds about how investors would react. And the reality is that investors that have been involved in shipping or invested in shipping for the past decade, invariably they didn't have an extremely exciting experience. And that's why sometimes you see reluctance. The reality is that the shipping market is very volatile. And what we did, and that's why we decided to also go with a leasing solution to fund shipping, is that we wanted to take that volatility out of the shipping market. Because in essence, what we offer is an investment in a real asset with a ship in that case, but with stabilizers on top of it. Think of a cruise ship, for example, that is in the high seas. Sometimes it gets choppy and the passengers feel very uneasy. But in our case, we have stabilizers like the cruise ships do, and it creates some stability back into the investment horizon and world. And the reality is that because we're LIBOR-based, I suppose you all are, and it's a floating structure, it also provides an inflation protection. So you're investing in a real asset, which by itself is an inflation protection, and you also have a floating structure, which means as rates go up, your returns go up at the same time. So I feel that those two elements make the structure more robust and provide both the owners, our clients, a flexible structure to actually fund the business with, and investors a more predictable and stable return coming from real assets.
Harris, you had mentioned, and I don't think you can have a panel today that doesn't talk about sustainability and targets to net zero. I mean, the traditional finance world, if you will, sort of has come to take some sort of a role of either encouraging that through some of the, I guess, the green bonds or the Poseidon principles. I mean, is this something that you find, you're saying, Harris, that you do take this into consideration, but is this something that goes into your investment decisions? Is it something that your investors are sort of pushing, or is it a different focus on this than maybe the more traditional lenders?
Well, they didn't really have to push hard. I mean, in my whole career, I've tried to be involved in technology, but also in initiatives related to the environment. I was one of the first 11 signatories of the Poseidon Principles. A lot of my clients accuse me for that even today, but nevertheless, we did it, although it was not always an easy decision because you actually have to roll your sleeves and do a lot of work. And we also, I remember back in when I was still living in Rotterdam, we had an initiative with the Green Award Foundation, whereby we would actually subsidize or reduce the margin for owners that met certain environmental criteria on the basis of the Green Award. So it's not the first time, to give you a short answer. One of the first things we did when we set up the company is we also established our ESG policy, which obviously looks at the environment, but it also looks at governance and social responsibilities. In fact, I'm very proud to again say to you all here that we became an associate member of ELMEPA maybe a month or two ago, because I believe from our perspective as well, we need to chip in for the benefit of the environment and the industry with an organization that goes back 40 years. It's not a novice. And we take an active stance, just not a theoretical, because we also, as I mentioned earlier, are prepared to fund and help owners with the strategic thinking about retrofits. So, there's many different ways that we're actually tackling this issue of ESG, but it's definite that the train has left the station or the ship has left the port. There's no way back. I mean, I know it creates uncertainty, and we all have to go through a transition period. But to me, there's just so much funds going into new technologies today that it is, I suppose, a predictable surprise that we will have new technologies going to ships in the next, 3, 4, 5 years. And that creates a challenge, but it's also the world's greatest challenges are the world's greatest opportunities. So I welcome everybody to live up to them.
All right, go ahead. You had a point you wanted to make on that?
One small remark. I mean, obviously ESG is important. That goes without saying. And I understand what Harris is saying, given the fact that he's focusing on more modern tonnage, as I understood. But I think it's also fair to say that everybody plays his role. I mean, if you look at different shipping companies, you have innovators, you have early adopters, you have early majority, and you have late majority. I realize it's a simplification, but I guess the traditional banks focusing on maritime corporates may focus more on the innovators and the early adopters. Traditional banks and alternative lenders meet each other probably in the early majority, and maybe we are focusing a little bit more on the late majority, where let's say the green shipping aspect is maybe a little less prominent than in some of the other sub-segments in that respect. Having said that, it plays a very valid role, because if innovators or early adopters cannot find a home for tonnages that is getting slightly older, and they need those funds to reinvest or invest in innovations again, then everything comes to a halt as well. I mean, new technology, innovation, all good, but at the end of the day, the economic life of a ship is still 20 to 25 years, and therefore it needs different means of funds during that lifetime. And there, the banks play a role in the early stages, and talking about direct ship finance, there we play a role in early majority and late majority.
Ted, if I could just chime in, I think first of all you need to separate between the E and the S and the G.
Also,
I think as far as the latter, the S and the G, I think everyone, something that we're all, speak for everyone, we're all very focused on, and everyone should be very focused on it. When you're talking about the environmental aspect, I think this is a matter of preference and taste, and this is mainly driven by our investors. So I can tell you that our European investors are very much focused on ESG, or on the environmental side, and are looking to put money to work in transition funds, and they're also willing to trade pricing for it, meaning they're willing to earn a lower rate of return in exchange for participating in those ventures. Whereas, for that reason, we've also Entrust has launched Purus Marine, which is actually a company that was set up to own and lease those type of assets. Now, on the U.S. side, we see less of that, and still, if most of our investors would, it's not something. Let's just put it this way: that is in the top of their priority list.
Switching gears a little bit, this panel is focused on the direct lending and on the leasing side. And I just wanted to touch on private equity, particularly after sort of the financial crisis. So much money flowed in. Now we're hearing more about sort of the exit of that private equity in the current markets. But it is still there. And Omer, maybe I'll start with you. I mean, you do have some equity investments as well. Do you see what do you see as the role for that
Sure,
today?
thank you for that. And as you pointed out, we do have roughly today half of our book in terms of an NAV is equity, and we hold I think more than 100 ships in around 18 joint venture investments, so it's something that we're very much active in. Look, for us, as I mentioned, we wanted to be a one-stop shop, and it was always a counter-cyclical approach to investing, meaning that we knew that there'll be a time, as you pointed out, 2016, 2017, where you can achieve the best risk-adjusted return, risk-return profile on the back of senior loans. And when the market is becoming a little bit more tight like today, and we're seeing inflation picking up, maybe we feel that there is some merit in actually holding the assets and playing the shipping cycle, and which is why we have turned into or increased our equity investments portfolio.
If I may jump in here, I firmly believe that there might actually be even basically a strong coming back from private equity into shipping. And I think that's the very simple reason for that is surprisingly the securities market, of listed equity don't provide liquidity. I mean, theoretically, people go public in order to have a liquid asset that they offer the shares in the market. But if you look at even the larger pure shipping companies that are listed, and if you try to buy a significant amount of your shares you move the share price immediately, and what you consider to be an attractive entry price might, after a few trades no longer be the case. Now, if you are nevertheless convinced you're facing a buying opportunity and you should go into that market, you will find out that buying, for example, dry bulk is a very liquid thing to do. You can buy it, you can sell it the next day if you want to. So surprisingly for investors that have big wealths to manage, providing private equity to the shipping industry in terms of partnerships, in terms of asking people to manage the ships that they buy in various structures is something that I believe will see a strong recovery, especially now that people have experienced over the last 18 months that it only took a few months to take shipping back into a very attractive investment. And usually, good returns attract people.
All right, well, I see the clock is winding down about 4 minutes, but maybe I'll just open this to everyone. Where do you sort of see alternative financing going over the next 2 years in terms of market share, in terms of sort of the products? Do they become closer to what the traditional bank debt is? Are there certain characteristics that the people want? Where would you see, what would the changes that you would see, say, over the next 2 years, if you had a crystal ball? Tim, I'll start with you.
No time to think. I think I think with Poseidon and with changing capital requirements at banks, I think you'll continue to see a retrenching from quite a few lenders in the space, as there's quite a few banks that even this year have announced that they're leaving the industry. And, I do agree there are some banks that have left and now miraculously come back and are almost buying their old portfolio, but I think in reality there will be a restriction of capital. Whether that capital flows into alternative lending, I think then also becomes, what does alternative lending do to encourage, to attract those people? And it could be tough, because if you are used to having relationship pricing from a bank, then even with all of the bells and whistles that we've talked about, you may still balk at the price. So there'll probably have to be something that alternative lenders have to do to resemble something a little bit more like bank financing in order to attract people over. But I do think there'll be opportunities for alternative lenders to pick up loans and customers who have historically relied on banks.
Alex, do you?
I personally believe we'll see a coexistence of the various forms of financing, and I wouldn't say, one will have a stronger role than the other in the years to come. It will just depend. Shipping is volatile, there will be volatility, and there's different advantages of the various sources of capital in a very situation. I mean, if there's, distress, then private lending, not being that much regulated, can move much more flexibly than bank lending can. But I also must say there's still so much liquidity on the globe. Let's see whether central banks start, trying to catch it now. But if they don't, there is a lot of liquidity, and we see it in the banking space, we see it in alternative lending. So I think the good news for the time being is there's alternatives. I don't see any financing gap. I don't see in the next 1 or 2 years. And so far, and beyond, I would say beyond 2 years in shipping, don't even look at it. It's seriously impossible.
I think, or at least I hope, that owners also here in the Greek market understand more and more the value of a diversified funding strategy for their business. I mean, I think, and I know that when I was sitting on the owner side, it can be very, very hard to be to rely on only 1 or 2 banks going forward, because sometimes banks change their strategy, and if you're then with the wrong bank, then you have an issue. So I would advise everybody to look for opportunities, and those opportunities are there today. The glass is half full as far as I'm concerned. Look for those opportunities that are well tailored to the specific requirements that you have. And I think your approach as an owner for younger tonnage should be different than for older tonnage. And that at the end of the day pays off, I think. And the opportunities are now there.
Thank you. Look, I think shipping, as we all like to say, is a very traditional industry, and the funding for shipping has also been traditional in the sense that we always had senior secure loans. They were very much monoline type of business. The banks were very similar to each other, just competing on pricing. So I think, as Harris mentioned earlier, what we've done, we've kind of expanded the menu of options that ship owners have. And still, if you compare it to other industries, shipping is still way behind. Unlike the aviation industry, which is smaller than the shipping industry. I mean, there are no EETCs, there are no structured product, there are no CLOs. So I actually personally feel there is more room to grow from here. And I hope that we'll continue to develop and offer a wider menu of options to ship owners.
Harris, the last word.
Thank you. Look, I firmly believe that in the next 2 years, at least speaking on, from a leasing perspective and with a leasing hat on, that industry is going to become bigger. It's going to take a material space in the provision of finance to the shipping industry, like it has in the financing of the aircraft business. In the 70s, the aircraft fleet was financed through leases to the tune of 1%. Now it's probably 53–54% of the fleet, and you can imagine how much bigger the aircraft fleet is today compared to what it was in the 70s. So I see a similar trajectory for the ship leasing business, and it's going to be because of the elements that I mentioned earlier, but also because of its symbiotic relationship with the owners, with other capital providers, and also with the banks that are still involved in shipping, because I think it's the symbiotic relationship that allows us to provide higher leverage, more flexibility, and of course more attractive terms overall.
All right. Well, we will stop there. I thank all of you very much.